Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview series. I'm delighted today to be joined by Russel Robertson, Chief Commercial Officer at the Dubai Mercantile Exchange. Russel, thanks so much for joining us today.
Hello, yes, I'm in Riyadh today, so it's good to speak to you from somewhere different.
Fantastic, fantastic. Not too far from where we are here in Dubai. Okay, Russell, well, let's just start with a bit of an overview on trading volumes, if you like, on the DME. We saw a pretty healthy year in 2023. Can we look forward a bit to this year in the context of what you're expecting and oil flows, etc., and then talk about how futures trading and that's going to perform versus, if you like, last year?
Sure. Yes, 2023 was a good year for DME. We've spent a lot of time working with our market participants, trying to bring in more paper into the marketplace, trying to adjust the way we manage other types of clients. So it's been growing since 2020, since we all saw the demand destruction, which affected a lot of things. But we look at it in two ways. We have our physical volume that come through the exchange, and ultimately the DME Oman contract is the largest physically delivered futures contract in the world. So that's a key part of and an indicator of Chinese demand ultimately. So what we've seen as an indicator going forward, just using data that we have, we look at Q1 loading cycles. So if you look at trading of November through to January on the exchange, we averaged around about 26 million barrels of oil through delivery. So that's 28% up on the same cycle last year. So again, that was last year was an increase of about 20%, 22%. So that's my indicator of what's to come, because you tend to find that the end users and the refineries are planning that load. So unless something particularly big happens, I hope that trend continues. So that's been interesting. And if we look at February trading now, actually, the trend is there too. So just to add on to Q2 beginning, we've still got a few weeks to go, but it's a sign.
Okay, well, I mean, let me just stop you there and just kind of
Sure.
take up that point you said. The majority of this crude, the physical deliveries go to China, and the indicators so far early this year are positive. But there is generally concern, isn't there, about where that growth and demand is going from China this year. Of course, taking into account their plans on the refining side, which they've kind of declared in terms of product exports, etc. So, I mean, from a DME perspective, along with the rest of the market, are you concerned at all about the demand for that crude?
No, I've come to the conclusion, speaking to many different traders, that and also some of my own beliefs, but it feels to me like the historical economic indicators, GDP and growth levels and things like that, are becoming slightly disconnected to how we see the import-export market of the commodities, and not just crude, but other things too. So I'm not particularly concerned from an oil perspective. The fact that they've already declared those export quotas is just a good thing for the end user, because they can plan ahead. So yeah, from what I'm seeing, I'm not marrying up the negative commentary we hear about Chinese growth versus. I mean, you can look at last week, right? We're just in Lunar New Year travels at the moment. Numbers have just come out to show that it's been higher than pre-COVID. So that's a very strong sign. And those indicators have been used in the last few years of signs of negativity. But to me, I'm fairly positive on China, just in a different way, maybe to an economist might be.
Okay, and what about, let's talk about the other big consumer. While we're talking about China, let's talk about India. And the fact that it's growing more than China. The expectation is that its economic growth at least is going to perform a bit better this year, and as it did last year. Of course, it's also been taking more Russian oil, India, in the last 12 months than it was before. Is that impacting thinking on your exchange in terms of obviously Omani crude, and even how that fares against other crudes that may be being impacted because of this Russian flow?
Yeah. Not so much. We definitely have seen a decline in barrels going to India from Omani crude. That was very significant at the beginning. Not so much for the exchange, but just in flow. India, like China, are a swing buyer, so they ultimately are going to go to where the value is. And at that time, the Russian barrel was clearly cheaper if you're willing to take it. That seems to be changing slightly. So in Q3, we did see Omani barrels going to India again. So yeah, we need to just see how that data pans out. But yeah, it clearly did have an impact. But Chinese were quite happy to lift the rest, so it didn't have any impact on us. Supply and demand fundamentals are clearly still there, and that barrel will find a home. Omani crude is limited in its production, and it's a very well balanced market. So if something becomes available somewhere else, someone else will take it. Generally, it's very rare to see. Very rare to see a distressed cargo of
a distressed cargo on the water.
Yeah.
That's good to know. Let's talk, Russell, about the kind of quite recent news about the stake that the Saudi Tadawul group took in the DME. Tell us a bit about what sort of the opportunities that you see, or challenges even, in terms of that transition into this new Gulf Mercantile Exchange. What real difference is it going to make, and any potential sticking points of transition?
It's very exciting. It's why I'm in Riyadh today and yesterday. We're here for the Saudi conference, the financial markets conference. I mean, you look at what Dubai's like, it's really, really buzzing here. And I'm understating that a little bit. I'm being quite surprised with how busy it really is in the conference. I mean, you literally have to queue up to get into the talking slots, and I've never seen that before. So from that side, the desire in Saudi to create something, it was very strong. The impact on us is we're going to be looking at expanding out our product offerings. So we're historically an oil exchange, but we're working with Tadawul, working with other Saudi corporate partners, commercial entities. We'll be looking at listing out new asset classes, particularly with the forecast of trying to find a way of creating regional pricing for commodities in general. Anything from minerals to metals and agricultural products. So we'll use a similar sort of idea about what we've done in creating the Omani benchmark, and look at other ways of how we can do that in the region for other asset classes. And that will be from an industrial level all the way down to potentially giving access to commodities markets for GCC nationals. So when you listen to the forum here, a lot of the discussion when they talk about derivatives generally is around about equities and single stock options and things like that, which is a key trading instrument for the GCC national. But again, there's something that we need to educate on, as the concept of derivatives and commodity derivatives is slightly different for the mindset. So it's something that's been done by the CME in the US and other places. Yeah. So it's just part of the futurization of the commodities market.
That's really interesting. And any particular commodity derivatives that would come first on that list of adding products? Anything that would be sort of first in line?
So not particularly one to announce quite yet, but we met some quite significant producers of assets yesterday. We've got more today. We hope to get this transition done in the next, before Ramadan, and then hopefully we can start talking to the market about particular ideas. We have a set of ideas on our own, but we need to really do some good market commentary and partnership now, working groups to bring the correct solution to the market. We don't want to. It's very difficult to just copycat derivative contracts these days. So you have to be innovative and come up with solutions that are going to really work for both the supplier, the producer, and also the end user.
And are there any other exchanges in the region that are looking to do that, to expand beyond the oil buckets, if you like? Is there room for more than one player to do that?
Of course, yeah. There's always more room. I could be trying to do, but I don't see their growth plan. But yeah, I mean, there's always room. exchanges like ourselves, we find it a positive if other contracts come into the market. It just, and as an ex-trader myself, having multiple products to create arbitrage and trade portfolios is only a good thing.
Okay, Russell, let me ask you then about, in terms of competition, um, we've seen obviously that the IFAD upper IFAD exchange added the Morban crude 3 years ago. We've seen how that's taken off in terms of volumes and interest, etc. There is plans to add another crude, which is the Upper Zakum, to the ICE futures Abu Dhabi this year. Is that, again, I mean, just looking at the sort of volumes and interest that you as an exchange, IFAD as another one, ICE futures, would be looking to get in terms of interest, people, participating. Is that a positive thing? Would it impact the Omani contract on the DME or not? How do those things sort of reflect on each other?
Yeah, sure. It does create a bigger ecosystem. Merban, when that was launched, is a more of a sweet crude, so it isn't competitive in the sense of a grade. So the end users of those grades of oil are slightly different. There has become a much bigger arbitrage taking place between particularly Merban and Dubai. So there is that sweet sour spread taking place, and that's a really good development in our marketplace. Yeah, Upper Zakum seems to be something that could be exciting. We haven't heard any official announcements about that yet, but I don't expect it to again be impactful per se to the DME Oman future contract. I expect it to be more of an add-on. I think you just need to look at where does that Upper Zakum currently priced, and what would be the impacts of moving that price, which is ultimately what's happening. So I'll let you make your own conclusions on that one. But yeah, it's a positive. I think if you look at when the INE Chinese futures contract started, that has only again created opportunity for traders. So the more a trader can, traders historically used to trade flat price quite commonly. That's becoming less and less, and the arbitrage spread between contracts is a much less risky investment than just a flat price move. So we see that much more now, and the east to west futures portfolio is becoming much more of a interesting trade for people.
Okay, I mean, and talking about trading, which is all about what it's all about today, our conversation. But just to talk a little bit about Aramco, we saw them recently trade a sort of third-party crude, if you like. I mean, of course, Aramco has its own trading arm; it trades its own crude, etc. already. But it's kind of seems to be making a foray into that. What does that mean when big NOC players like that, and next you might see KPC or others, or ADNOC even, go on to the open trade market, if you like, and go beyond their own crudes? What does that do to the existing volumes and the existing mechanisms of the market?
Yeah, I think the one important thing that everyone needs to think about is it's Aramco trading, very much like ADNOC trading, very much like OQ trading, which is the Omani. These entities are trading houses. They're not the producer. They're not the NOC. So they are designed to take part in the derivative market, the secondary market, and ultimately maximize their systems and their end product. So Aramco or Aramco Trading or any of these entities, yes, you mentioned KPC, we hear that too. It brings an additional batch of liquidity into the market, which again, liquidity creates liquidity. So it's just again a positive thing. I don't see any side of it which people should generally worry about.
Okay. I mean, and just to talk about benchmarks a bit, we saw last year the WTI move into the Brent benchmark. Again, sort of as the dynamics change in the market, these decisions are being taken. They're logical. But what significance did that have for other benchmarks, if at all? And what does it tell you about the future trends of how those might continue to marry or compete?
Yeah, derivative markets have to be innovative. They have to move with the times. The Brent basket was creating issues for some people in the market. So there had to be something added to that. TI was a little bit controversial, I guess, because it's slightly away from the things that people were used to, and it does create additional legs of trades that they need to do that. But impactfully, it hasn't. We haven't seen any impact on the big benchmarks, so the WTI and the Brent crude contract. Neither of them, as an outright contract, have been impacted from a volume sense. The Brent WTI spread, from a pricing perspective, seemed to have become less volatile. Again, that's a very good thing for traders.
Yeah.
And again, this is not my opinion, but this is just something you hear from the market. But it seemed to have created maybe potentially cap on some of the other benchmarks. So some of the more sweet crudes may now have a ceiling on them due to this WTI into Brent and the impacts of that spread and arbitrage between one another. And secondly,
will that impact the physical trading of any of those crudes, or the physical future volumes of those? You're talking about sweet crudes, let's say from South America, the ones that we're seeing increase in volume anyway as a trend.
Yeah.
How does that then, reverse, if you like, impact on that?
Well, it comes down to the price, right? So if a refinery is complex enough to be able to change grades, and a benchmark is lower for one than another, then refining economics just tells you that they may be more willing to shift from one to another. I don't think we're seeing that yet. I don't think so. But WTI, I mean, I don't have the official stats, but from what I guess I shouldn't get quoted, but it's something like over 60% of the time WTI is setting the price of Brent. And I think these are official numbers. That something like, when you look down the curve where they take into account the laycans, it goes up to like 87% of the time. So it clearly is becoming the cheapest to deliver on more cases than not. So there is an impact. Where that goes from here, I think everyone is looking at that. The thing we see in Asia is, I'm based in Singapore, so I work a lot with Asian traders, is that there is also a corporate element to this too. So a WTI book is generally run out of the US, most likely Houston, whereas a Brent book is quite often run out of Asia. So until that changes, you may have some limited impacts on the WTI Brent spread, because you've got different people trading it. But ultimately, in the long run, there would have to be some sort of crossover there. So yeah, it's interesting because there's many elements that come into trading.
And of course, one of those is that there's more physical US crude also making it out of America as a sort of what looks like to be a continuous trend. Russell, what about, just to talk about general liquidity in the region, in terms of regional futures markets? When the IFAD Raban contract launched, a lot of questions to that exchange were, oh, but come on, you've got a few people signed up, as stakeholders, but there's still, the volume isn't what it needs to be. And so, do you see that changing for the region in general going forward? What would it take to attract more of those players, if you like, into the exchanges?
Well, I'll dip my hat to IFAD, because Merban numbers have gone up significantly in volume, in trading volume terms. So they are doing something right. The thing to remember when you talk about these regional contracts and regional exchanges, a lot of that trading is not taking place in the region. It's taking place probably in Singapore, is quite common. The trading you generally see from the region will be more speculative traders, maybe coming from India and things like that. So it's two different steps, and that's a part of why we're working with Tadawul, because we want to try and build that local institutional trading, which isn't as prevalent as if you look into London or Singapore or New York, for that matter. So that idea of the financial centre in the region needs to grow, and that will bring another unlocked piece of liquidity to all of our exchanges, and ultimately make us more international, which is where we need to go.
Russel Robertson, Chief Commercial Officer of the Dubai Mercantile Exchange, thanks so much for joining us today on Halftime Talk.
Thank you very much. It was good to talk to you.